So you're thinking about refinancing, but we're not sure whether or not to do a home equity loan or a normal refinance. So what is the difference? When should you do one? All those good questions we're going to address here. So first and foremost, home equity loan is kind of a big term. Like a home equity just means like an umbrella. And there are certain loans you can do, like you can do a home equity loan that's a cash out. You can do like a second lien that's like a line of credit, things like that. So home equity in general can mean a big term, but it does mean tapping into the equity of your home and home equity loan. So in a refinance is an even bigger term because inside a refinance is home equities, rate and terms, other things like that. So let's just talk about real quick, what is the difference? When should you do one versus the other? So which one's better for you? So it really comes down to purpose and intention. What do you want from a new mortgage? Like, what are you trying to do at this very moment? So a normal, I'm gonna use air quotes, normal refinance right now for a rate and term refinance or something like that. Rate and term means you're going to change maybe the rate or the term. The reasons for those type of loans might be to save money, right? That's an obvious thing. Save money, whether it's interest payments or mortgage insurance payments, things like that, but to save money. And that's why you're doing it because maybe rates are lower, or maybe you can drop MI or mortgage insurance or PMI or MIP. They're all the same. But ultimately that's one reason, right? Is you want to save money. The second is how you can save money, even if the rate's higher than what you got, you might save money by refinancing if you reduce your term. So if you're currently doing a 30-year mortgage, maybe you're 2 or 3 years in, you got some great rate, but now you got a pay raise, or maybe that you're going to retire in the next few years, or just you have this goal of paying off your mortgage quickly, they refinance into a shorter term, meaning you go from like what was a 30-year payment now versus a 15. That could also save you money, even if the rate's higher, which is, seems counterintuitive, but you absolutely can do that. And some folks might say, man, you can just do that on your own. You can just pay extra. You could. There's no question. You absolutely could. You don't have to refinance to do that. If you want to put more money towards your principal, the difference is by refinancing into that shorter term, you have to. So it forces you to make that payment and pay it off quicker. So that'd be kind of the way of save money. That's under the normal refinance. One other reason why you might do a normal refinance is to create cash flow. So I want to make sure there's a very big difference between cash flow and saving. So people say you save $300 a month or you save $500 a month on your mortgage payment when you refinance. That's not necessarily true. That's cash flow, right? So meaning if somebody was 10 years in their mortgage, they've had it for 10 years, this whole mortgage, and now they refinance and they go back to a 30-year, yeah, the payment most likely is going to go down. The reason being is because you're resetting the clock for the whole 30 years versus had they just refinanced and maybe kept the 20 years that they have left, or maybe they could have shortened it and had the same payment. So understand, like, savings doesn't necessarily mean what you keep in your pocket each month. That's the cash flow. So there are a lot of instances, and again, it depends on your circumstances, where the cash flow might be more important than savings. If times are tough, maybe family just had a baby, one of the parents is going to stay home, and now income's a little tighter, it'd be a good reason for cash flow. Or just maybe commissions are down, the economy's not working for you, and you need cash flow. There's a lot of good reasons out there why cash flow, but those are the two reasons why you might do a normal rate and term: to save money, right? Whether that's through interest, mortgage insurance, reducing the term, or to actually just create some cash flow to help you create, some extra cash staying in the bank each month. So those are the good reasons to refinance and do rate and term. The home equity, again, should you do it or not do it? Home equity means you're tapping the money. And so why do you tap the money? Well, it's interesting. So a cash out can be a whole bunch of different reasons, right? Tap out the money. You could be paying off bad debt, like credit cards, things like that. You might pay off things like a car that helps create the cash flow. Kind of go back to the first one, cars, because they're only 3, 5, 7-year loans. They got big old payments. So maybe by paying off that car, you create the cash flow each month, right? So even though it's not quote unquote bad debt, to me, bad debt's like credit card debt, cars, student loans, houses. I don't consider those necessarily bad debt. Maybe you need cash out for something like a business, right? You're a business owner and you need or want to expand. You need some equipment. You want to do something. I think that's a good reason to do it. Home improvements. Maybe you want to put in that pool. There are home improvement loans, by the way. Those are different than home equity loans. You still are accessing the equity of the home, but a home improvement loan is different. So check that out. I'm sure we'll put a link somewhere down here to help you with that. Maybe you're paying off all these debts just to simplify. Maybe you got like 17, I'm making 17 up, but you got 17 different credit cards and car loans and student loans, and just to consolidate it. Sometimes financially, it just may be a neutral benefit. However, if it just makes it to where your whole life is into one payment and you can focus on knocking that out, that can be a really good reason. To do, maybe you have to refinance, right? For a cash out. Maybe you have to refinance because maybe, unfortunately, maybe you got divorced, or maybe fortunately you got divorced, but you got to pay somebody off. So, or the court is making you refinance and pay somebody off, or something of that nature. So that's a good reason to do a refinance rate, or pardon me, a home equity loan as well. So once you figured all that out, and we'll put a separate link to these blogs, you then decide, okay, I'm going to refinance, or I'm going to do a generic, normal loan, or I'm going to do a home equity loan. Now, once you decide you're going to do a home equity loan, there's actually different ways to skin that cat. You can do it first, you can do a second. So we'll put a link somewhere down here to talk more about what to do as far as the home equity. But I think those are all really good reasons of what to do in terms of like just thoughts. Certainly, if you have questions, call us. The Mortgage Mark team is here to help. We'll answer those questions because not every situation is the same. And I think you know that. But those are the big differences, right? Why do you want to refinance? Are we saving money? We trying to reduce the term? Versus we're trying to get cash out to go do something. So I think those are the big questions. And again, call us if you're not sure. We'll walk you through how to do it, what to do. And sometimes we're the answer and sometimes we're not. There's a lot of options out there. We do most of what people need and want, but certainly there's going to be instances where we can't and don't and won't and don't want to. So we will absolutely send you to somebody we know, recommend, and trust. So with that said, reach out to the Mortgage Mark team. As always, thanks for watching. And when you think mortgage, think Mark.